Welcome to today's tutorial. I'll be walking you through International Accounting Standard 16, IAS 16, Property Plants and Equipment. In this tutorial, I'll be taking you through the objective of the standard, the scope of the standard, definition of property, plant, and equipment, recognition, measurements, the recognition, and disclosure of property, plants, and equipment. So what is the objective of the standard? The objective of IAS 16 is to prescribe the accounting treatments to property, plant, and equipment. The principal issue are, number one, we're looking at recognition of property, plant, and equipment. There are some basic words here. The first one is recognition. The second one is the carrying amount, depreciation, and impairment losses. So we'll be looking at this in detail, but let me just take a brief moment to explain what recognition is. The standard provides the guideline for recognition in the sense that before you bring an asset into your book, you have to look at the standard. Should I, in the first place, bring the asset into my books or not? So if I am to bring the asset into my books, what are the guidelines? How do I recognize the assets? So recognition is talking about bringing an asset into your books. Carrying amount. The asset has been brought into the books this year. Let's assume that the value at recognition is 2 million. As at the date of recognition, that is the value of the assets. A year later, the value of the asset will not be that same 2 million. So how do I determine the value of the assets in subsequent period? That gives rise to the carrying amount of the assets. In my books, last year, the asset was 2 million. This year, what will be the value? The next concept there is depreciation. So at initial recognition, whatever the asset is, minus depreciation for the period, that will give you the carrying amount as at the end of the period. Then impairment losses. There are losses that occur that makes these assets carrying amount to be less than the realizable value or the fair value of the assets. So you want to look at all of these concepts before you determine the carrying amount of an asset at each particular accounting period. So now, what is the definition of property, plant, and equipment according to the standards, according to IAS 16? So the first is the standard defines PP as tangible assets as one that are held for what? Production of goods and services, for rental to others. These are the keywords in the standard definition, or administrative purposes. So just 4 keywords there. Tangible assets that are held for production of goods and services, for rental to others, or for administrative purpose. And don't forget that before you recognize an asset as PPE, it is expected that the asset should be used during more than one accounting period. That is, the asset should be able to last for more than 1 year. So now, example of property, plant, and equipment is your land and building, your machinery, your motor vehicles. All of these, they are tangible assets, assets that you can see, you can feel, and you can touch. So we classify them as property, plant, and equipment. Your furniture in the office, all of these are property, plant, and equipment. So the scope, what is the scope of the standard? The standard applies to property, plant, and equipment. But there are some property, plant, and equipment that the standard does not apply to. One of such is assets that are classified as held for sale. This is IFRS 5, non-current assets. The standard does not cover this type of assets. So if an entity decides to sell a particular asset and the asset has been classified as held for sale, such assets will not be treated by IFRS, by IAS 16, but rather by IFRS 5. Second category of assets that will not be treated by the guidelines of this standard is IAS 41, agricultural products, biological assets. And the next category of assets that will not be treated by this standard is IFRS 6, exploration and evaluation assets recognition. So this has to do with exploration and mineral resources. So these particular set of assets that I have listed here are not covered by IAS 16 property, plant, and equipment. So recognition criteria. We are saying recognition. Earlier on, I said recognition has to do with bringing an asset into your books. So what are those guidelines? What are the criteria for recognizing an asset? The cost of an item of property, plant, and equipment shall be recognized as an asset if and only if, number one, it is probable that future economic benefit associated with the item will flow to the entity. That's number one. Before you call something an asset, that means you are expecting economic benefit from that particular asset. Number two, the cost of the item can be measured reliably. We found out that in some of the developing nations, or maybe let's say small and medium scale businesses, there are some businesses that they just buy assets, they don't bring it into their books, they use it maybe 2, 3, 4 years, they now employ an accountant, and the accountant now will now start struggling. What should be the value of this asset? How do I recognize these assets? Because of incomplete record. So this standard is saying that before you bring an asset into your accounting record, the cost of that asset, you must be able to measure it reliably so that you don't mislead the users of the financial statement. Because if you don't measure the cost properly, you may either be overstating your assets or understating the assets. So the standard provides the guidelines for recognizing an asset into your books. So recognizing an asset, how do I recognize an asset? We talked about the cost. So how do I measure the cost? Cost must be measured reliably. So at initial measurement is maybe when you just bought the assets for the first time and you have not brought it into your books, such assets should be measured using the cost model. At initial recognition, the initial measurement, I'm taking it again, should be based on the costs of the assets. And what are those variables that constitute the cost of an asset? Number one is the purchase price. How much did your company buy the assets? After purchasing an asset, there are some other costs that may be associated with that purchase. For instance, if you bought an equipment overseas, you may need to ship it into your country, and as such, you may pay freight and other expenses. Such expense should be added to the purchase price of the assets. There are also directly attributable costs of bringing the assets to a working condition. So you bought an asset and there are some works that need to be done before you can use that asset. Any amount of money that is spent in doing such work is also added to the cost of the asset, which is that purchase price. Initial delivery and handling costs, directly attributable costs of bringing the assets to a working condition. Your company may purchase an asset and may need to do some extra work to bring the asset to a working condition. That cost should form part of the initial cost of the assets. That cost should be added to the purchase price of the assets. Also, is the initial delivery and handling costs. If there is need to transport the assets to the location where the assets will be used, that cost of delivery should form part of the initial cost of the assets. We also have costs of testing, costs incurred in testing, whether the asset is working properly. So when an asset is bought, you want to test the asset and be sure that the asset is functioning properly. That cost of test running should form part of the initial cost of the assets. Import duties and non-refundable taxes, costs of dismantling, removing, or clearing a site for installation. So you may need to install an asset in a site, maybe a project site. After the project has been concluded, there will be need to dismantle that asset and restore the site back to its original state. That cost of dismantling or decommissioning cost is also going to be capitalized as part of the initial cost of the assets. Also, is the cost of site preparation, installation and assembly costs, and also there may be professional fee. Such will be added to the cost of the assets. Maybe you are building an office and you need an architect or a legal person to sign some agreements. That cost should form part of the building. When I'm saying added to the cost of the assets, I mean that those costs, you should not expense them through the profit or loss. The installation cost, cost of delivery, import duties, cost of test running, all of these should be capitalized. You add it to that initial purchase price, and that will form the costs of the assets that will be taken to the statement of financial position. However, there are some costs that is not expected to be added to the costs of the assets. Number one is training costs. Training costs. You've bought an asset and you need to train people on how to use that particular equipment. That cost of training should not be capitalized. It should be expensed in that period. The second is cost of opening a new facility. This should not be added to the cost of an asset. The third, administration and other general overhead. Administration and other general overheads should not be added to the cost of an asset. Initial operating losses, cost of relocating or reorganizing an asset, relocating an asset. Interest on deferred charge. Interest on deferred charge means that you bought an asset and you are not going to pay for the assets upfront. The payment is deferred to a further date. There may be interest implication on this. That interest for deferring payments should not form part of the cost of an asset at initial recognition. After the initial recognition, there will be need for a company to determine the carrying amount of an asset at the end of every financial period. That is subsequent measurements. How will an asset be measured after the initial recognition of that asset? So there are two models for that. The first is the cost model, and the second is the revaluation model. So a company can choose to either use a cost model or the revaluation model. For any of these models that the company decides to choose, the company is going to use that model consistently for that particular class of assets. For instance, if a company chooses to measure motor vehicle using the cost model, means that all the motor vehicle of the company will be measured using the cost model. So the company cannot say, I'm going to measure half of the motor vehicle using the cost model and the remaining half using the revaluation model. All of the class of that particular asset will be measured using one of either the cost model or the revaluation model. So what is the cost model? Assets are carried at cost, less accumulated depreciation and impairments. In the previous slide, we looked at the elements of cost. How do you recognize an asset at initial recognition? When using the cost model, your asset will be presented on the statements of financial position at cost, less depreciation, less accumulated depreciation, and impairments. So you are carrying the asset at their net book value. Let me just use that word, the net book value of the asset. If there are any impairment losses, that will also be deducted. So the revaluation model, the assets are carried at their fair value as at the date of the revaluation, or as at the revaluation date, or the date of preparing the financial statements, if the asset is revalued at the end of the year. So what is the fair value of the assets? Now, when the asset is recognized initially, all assets are recognized at cost. But if an entity chooses to continue with the cost model, the entity will present the assets in the statement of financial position at cost, less accumulated depreciation. But subsequently, if an entity chooses to present an asset using the revaluation model, the company will present the asset at their fair value. And what is the fair value? The fair value is, let me make it easy, is like the market price of the assets as at the date of evaluation, as the price at which the asset could be purchased as at the date of revaluation. A transaction between an arm's length transaction where the price is not being influenced. So we are looking at the market price of the assets. That will be covered under IFRS 13, fair value. Subsequent expenses. At initial recognition, we were able to establish that there are some costs that should be capitalized as part of the value of an asset. So in subsequent measurements also, or subsequent expenses after initial recognition, costs concerning maintenance of the assets and some other costs are expected to be expensed through the profit or loss statement for the period they are incurred. Example, a company buys a motor vehicle and at initial recognition, the cost of the motor vehicle is 4 million. Within the year, or let's say a year later, the motor vehicle was serviced or was repaired. That cost of repairing or servicing the motor vehicle should go to the profits or loss account for that period. So a company could either expense a particular cost or capitalize the costs. So if the expenses is such that it's going to improve or increase the lifespan of the assets, such expenses is of a capital nature and should be capitalized as part of the value of the assets. For instance, I have a motor vehicle and I decide to change the whole engine of the motor vehicle. That is an expense that is capital in nature, and I will want to capitalize that cost instead of expensing the cost, since it's going to improve the working condition of the motor vehicle and also increase the useful life of the motor vehicle. So what is depreciation? When you buy an asset for 4 million, you don't want to expense the whole 4 million in the year of purchase for two reasons. One, it will be too heavy on the financials. You build a long-term asset like land and building, or plant and machinery, or maybe a new facility. You don't want to expense all of that money in a particular year. You want to apportion the money systematically, that amount systematically over the useful life of the assets. Assuming the assets is going to last for 4 years and the asset is bought for 4 million. If you are using the straight line basis, we'll look into that shortly. 4 years, 4 million, that's 1 million for each year. So the cost has been spread over 4 years. So this is in line with the matching concept, where you want to match costs and revenue. So since the asset is going to last for 4 years, we're expecting that the cost also should be spread over 4 years time period. So when does depreciation commence? An asset has been bought today. When do I start accounting for depreciation for the assets? Depreciation starts when the asset is ready to be used for its intended purpose. That means the asset must have been in the location and the condition intended for its use. So the moment that is done, depreciation should start counting as long as the asset has been in the location and the condition that is required for the asset to be used. So when should the company stop charging depreciation on an asset? Depreciation cessation occurs when an asset is no longer in use, either because it is disposed or sold. So when you are selling an asset, you want to determine accumulated depreciation, and with that, you determine whether there's going to be a loss or a gain on the assets. When an asset is retired or fully depreciated, in such instances, the assets will no longer be depreciated. Depreciation ceases. When an asset reaches the end of its useful life or is no longer utilized in a business, depreciation ceases. So let's look at this example. ZNX Co just purchased an equipment that will be used for the production of goods and services. You have been employed as the financial accountant a few months ago. The CEO has given you the following data with respect to the purchase of the machine. The graduate trainee has calculated the costs as follows. Is the invoice amount, trade discount, import duty, delivery fee, installation costs, pre-production testing, staff training costs, interest on loan, and the total cost of the asset is 5,330,000 naira. You are required to review the costs of the assets in line with IAS 16. So I just want you to take a moment and look at this information given. So look at the information given and determine if the trainee accountant has correctly computed the costs. So I want you to identify, just try and identify those costs that you think should not be part of the initial cost of the assets at initial recognition. Okay. Invoice amount, this is the purchase price of the assets. Trade discounts. What do you do with trade discounts on an asset? Should it form part of the initial cost of the assets? So trade discounts should be deducted. You deduct the trade discount from the cost of the assets. Import duty. Should it form part of the assets? Yes, according to the guideline of IAS 16. Delivery cost. Yes, that is part of the element of cost. Installation cost. That is correct. That's part of the element of cost. Pre-production testing. That should be part of the element of costs. Staff training costs. This shouldn't be. This should be expensed. The staff training costs should be expensed through the profits or loss. Interest on loan. So interest on loan taken to purchase an asset should not be capitalized in accordance with IAS 16, interest should not be capitalized. However, IAS 23, borrowing costs, gives a different opinion. If an asset is a qualifying asset, the interest should be capitalized. That will be treated in subsequent lectures. But in this lecture, under the guidelines of IAS 16, interest should not be capitalized. So the cost of the assets is simply 4,390,000 as against 5,330,000 initially computed by the accountants.